From the morning reading, transportation stocks have not been able to get anything going. The Dow Jones Transportation Average slipped to its lowest level since March 2014 on Monday, while the Industrials Average was still more than 9% above its own low. Theoretically, this is negative as it might indicate some weakness in consumer spending, but reality isn't that clear. The other times we've seen this kind of divergences, both indices have done fine going forward. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:50 a.m. Central Time, and I am recording this in preparation for the market day of January the 6th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And once again, we've got a lot of action in the overnight. And whether it's caused by the potential of North Korea doing a nuclear test or something else, bottom line, the markets are primed for weakness, and any excuse seems to create a problem for holding on for the bulls. The S&P at the time of this cut was down 15 points, or about 0.75 of a percent. The Russell was down nearly 0.5%, NASDAQ down about 0.7%, Dow down about 0.75%. And things seem to be getting weaker. And make a quick look here. In fact, right now the S&P is down 35 points, so it would seem that we may even be doubling those percentages that I had from this cut. The crude oil is down about 0.65%, euros down about the same, bonds are up about 0.2%. Interesting that bonds as safe haven status don't seem to be moving anywhere near as proportional as the other markets are moving down. At this time, I'm looking at the live feed on the ZB, the futures contract for the bonds, and it's up 1 and 23/32. So it is continuing to move, but not as fast as the market is moving down. Gold is up about 0.5%. In overseas action, you got China up over 2%, Hong Kong going the other way, down about 1%, as is Japan, down about 1%. Germany down about 1.7%, United Kingdom down about 1.5%. In terms of overseas action, that is pretty mixed, but mostly negative. In terms of macroeconomic reports for today in the U.S., we have ISM non-manufacturing PMI and crude oil inventories. And then more importantly, this afternoon, you have the FOMC meeting minutes. So we'll get some insights as to the thoughts that went behind that vote in December. In terms of tomorrow, in the United States, we have nat gas storage. If you're a nat gas trader, you'll want to pay attention to that. The weekly version of the unemployment claims. And then, of course, on Friday, we had the monthly employment report. In terms of current market conditions, as you well expect, volatility has been going up. Short-term VIX just under a 20, and I expect that that will be growing today. In terms of skew, it did drop a little bit yesterday, but still very elevated at a 135. That's about a 6-fold increase probability of a 2 standard deviation move within the next 30 days, and we may very well get that today. IV percentile for the S&P still relatively low, 29, Russell 29, Dow is a 30, and the NASDAQ is a 28. No indice put in a standard deviation move yesterday, so it was actually relatively calm by recent standards, though that would seem to be going the other direction so far today. Let's go ahead and look at the charts. And I've gone to the futures contract. So this is the S&P futures because of this overnight action. And you see we have broken through that swing low, and this continues to accelerate. So This is quite ominous. We've talked about this in recent days. If we do clear, and of course, once all the market participants come in at the cash open, that will be an important mark because sometimes things happen in the overnight on relatively low volume without all the participants that get reversed when the cash participants come in. We'll have to see what happens. I would imagine at least at the beginning, there'll be stops run. There'll be some people that'll be bailing out, and we'll likely have a continuation to the downside after the open. Now, it's only 7 o'clock Central Time, so we've got an hour and a half to go before we even get to the cash open. But as that cash open comes in, it'll be very important to see what happens that first 15 to 30 minutes. Now, after that, if we start to see the bulls come in and gain some footing and then reverse this action, that's going to be very, very key. Frankly, we're breaking through the horizontal support areas, and this is starting to break into that zone that we talked about where once it gets down through here, it could very easily drop all the way down to 1870 and have, a 100-point drop in pretty quick order. And I say pretty quick, it could be a number of days, but you look back here in August and see what can happen when you have a breakdown and then 1 to 3 days to capitulation. And in that time, those 3 days, you went from 2075 roughly to 1830. That is a very, very long way, and it happens very quickly. So that's what happens when you get a waterfall or cascade, and we are priming the pump for just that kind of activity. We'll take a look at the Dow. Dow, same thing, breaking down through that important area of support. NASDAQ breaking down, and Russell also breaking down, though Russell's the one that's actually coming close to the prior double bottom support. It will close in on that area before the others. So very, very important action going on there. In terms of current volatility futures, as you will expect, they're spiking, and they're currently running well up over 21, and big body going on there. And then bonds. Bonds, of course, safe haven status, and everybody's been concerned about the unwinding of the interest rate impact as the Fed has started that process, but it's still going to be the safe haven status. And if people around the world are highly fearful, they will be moving into bonds. Many of these people have to have their money somewhere. It can't just sit in cash. So if you're a mutual fund or some of these other institutions, they will move it into something, and they will park it often into the long bond as the safe haven status. So kind of keep that in mind. Don't be overly impressed with the impact of interest rates on the long bond in the face of this kind of fear. That's enough on the charts. Let's go ahead and go to the daily report. And the daily report's about as ugly as it can get. We haven't quite gotten to hedge risk level 3, though that would seem to be well within reach of today. We are on the top here. We'll take a look at our portfolio investor postures. We are phase 5. We're clearly the break of horizontal and diagonal support. We are in market in correction on the IBD status, accumulation distribution for the S&P D-, NASDAQ D-. GMI index went to its worst rating, a 0 out of 6. It's been in a sell signal all along since 1210, and that author remains 100% in cash. Stock chart status, you see, quite ugly. No changes from yesterday, but quite ugly on the short term. And that's now starting to bleed into the intermediate term. Intermediate term market posture is bearish with a bearish sentiment line. So that means that negative moves would be expected to be the long move, and bullish moves would expected to be the short moves. So can you keep that in mind? Position sizing opinions greatly reduced for portfolio, 0% for volatility base, down to 50%. Intermediate term market posture is now actually very bearish, with the S&P as our leader, dropping below the 50 with yesterday's action. That turned to very bearish, And frankly, all four indices are now in the very bearish camp, with the Russell closing in on severely bearish. If it drops below a 20, and that could again happen today, that would then go into the severely bearish camp. In terms of the hedge warning status, we'll read this as a 2 plus. As of last night, it would have been a 2, but with this action of this morning, I would call this a 2 plus. And of course, hedge warning status is a opinion as to the level of risk that is present in the market. It is not a prediction of a move down or a distance of a move down or how long that move down will last, but it is saying that the probabilities are very high compared to normal, which would be 0, for a significant breakdown in the market. So kind of keep that in mind. Now, level 3 is our highest. That's what we call crash warning, where the conditions are present for a significant crash. And indeed, we've broken through those significant horizontal support areas, and this could actually go to a level 3 during the course of today. So you should be taking the steps to review your risk and your portfolio, and start making steps to protect yourself should those things start to become true. In terms of the specific warnings, market in decline is still in present. Actually, the short-term, the intermediate-term status came off with yesterday's action, but we still have the first one. They often seem to move together. VIX futures are above an 18. We're in market in correction. VIX phase is increasing. Skew is elevated. As I said, about a 6-fold increase probability for a 2 standard deviation move versus normal. Current week out expected move is a 50, and as you might expect, that could be very much going up as we talk. And I don't know that this, yes, it does. It is being priced in. Currently, this has now popped up to a 58. So you can see the expected move a week out is starting to accelerate up. In terms of the new highs, new lows, yesterday was in warning status with 319 new lows on the New York Stock Exchange versus the new highs for the 1 month. In terms of risk aversion indicators, we now have 4 of the 5 as risk off. So that's a significant deterioration from yesterday. Fear and greed index is at a 41, so that has fallen a notch from yesterday. In terms of special opinions, conditions are not acceptable on option income strategies, covered calls, or put selling to initiate new positions for novice traders. Until we find a bottoming process and start to see some confirmation of that bottoming process, novice traders should strongly consider stepping aside and not initiating any new positions, and should instead be focused on managing your current risk profiles. Aggressive traders, given that we've just now broken through key support and that there is the potential for a very, very large down move, probably not a good time either for you to be initiating new positions in any of these 3 strategies. Mostly about taking probably short-term scalping and hedging, active hedging types of trades is probably going to be more of your focus than the initiation of any kind of new positions until we see something of a bottoming pattern. In terms of sector specific, you can see it's pretty ugly. Only utilities holding up, and utilities, of course, can go down just as well if we start to see significant down action. The other thing this tells us is consumer staples and utility, very defensive. Those are not the leaders in a healthy bull market, and we're anything but that. Yesterday was actually fairly positive across most of the sectors, but you see utilities up 0.79, consumer staples up 0.7. These are defensive positions. Healthcare also relatively defensive, depending on what part of healthcare. Obviously, biotech is a high beta area, not defensive. That should be enough for that today. And let's go ahead and scroll through a couple of these options that are currently available. Been talking quite a bit about the covered call mastery course of late. This class starts on January the 30th. This is a comprehensive course. You'll have a complete rules-based trading strategy when you get to the end of this course. Outstanding course for both those that are looking to learn how to properly screen stocks, fundamental analysis, technical analysis, charting, and then the complete set of rules into how to choose the right strike and expiration. Bottom line, cover calls are more conservative than owning the stock by themselves. So if you've ever thought about wanting to learn about options, this is the go-to place to start that process. Cover calls is the strategy that you would start that process. If you're an experienced options trader and you would like to have more of a true rules-based trading system around your covered calls as one of your core strategies, you would also find this quite helpful. Go to the hyperlink down here at the bottom to get a complete description of the course. If you choose to sign up, send me an email to Stephen@FalconGlobalTraders.com to get the registration form. As always, if you find this is helpful to your trading, you can subscribe to this YouTube channel. It's free, and I do this each morning that the market is open. You can like us on YouTube. You can retweet us to the Twitter followers and your StockTwit followers. Disclaimers, as always, hit the pause button if you need more time to review, and you see the hyperlink down here at the bottom for the full disclaimers. Otherwise, we'll see you back here tomorrow morning for the market preview from Falcon Global. And in the meantime, good trading